Good afternoon, class. Today I'm going to work on problem 2 from chapter 5, and we're still dealing with consolidated financial statements and intra-entity activities. So problem 2 reads, James Corporation owns 80% of Carl's Corporation's common stock. During October, Carl sold merchandise to James for $250,000. At December 31st, 40% of this merchandise remains in James's inventory. Gross profit percentages were 20% for James and 30% for Carl. What is the amount of intra-entity gross profit and inventory at December 31st that should be eliminated in the consolidation process? So first step, we want to pull out our data. So James Corporation owns 80% of Carl's Corporation. Carl sold merchandise to James for $250,000. 40% of the merchandise remains in James' inventory. Gross profit percentages were 20% for James and 30% for Carl. What is the amount of intra-entity gross profit and inventory at December 31st that should be eliminated in the consolidation process? So in order to calculate an intra-entity gross profit, we should use the formula determining the ending inventory. And then we multiply that by the gross profit rate. And that would give us the intra-entity gross profit. So IEGP. And so here our ending inventory can be calculated by taking the $250,000 and multiplying it by the 40% still left, which will give us $100,000. Then our gross profit rate was given to us at 30% for Carl. Which now gives us an intra-entity gross profit rate of $30,000. So our answer would be number 2. So a similar problem is problem 5-7. And here they're asking us, so it says Angela Incorporated holds 90% interest in Corby Company. During 2017, Corby sold inventory costing $77,000 to Angela for $110,000. Of this inventory, $40,000 worth was not sold to outsiders until 2018. During 2018, Corby sold inventory costing $72,000 to Angela for $120,000. A total of $50,000 of this inventory was not sold to outsiders until 2019. So in 2018, Angela reported separate net income of $150,000, while Corby's net income was $90,000 after excess amortizations. What is the non-controlling interest in the 2018 income of the subsidiary? So for this problem, we're gonna use a similar approach. What's gonna help you is following these formulas. So gross profit is equal to sales minus cost of goods sold, and then your gross profit rate is equal to gross profit divided by sales. Your markup, markup on cost is equal to gross profit divided by your cost of goods sold. And you have an intra-entity profit is equal to the transfer price times your gross profit rate. So once you have these formulas, we look back at the problem and we're going to pull out our data. So they hold a 90% interest in Corby Company. Corby sold inventory costing $77,000 for $110,000. $40,000 of this inventory was not sold to outsiders until 2018. It's important. During 18, Corby had inventory cost of $72,000 to Angela for $120,000. $50,000 of this is not sold to outsiders until 2019. Angela reported separate net income of $150,000, and Corby's net income was $90,000. So in computing our intra-entity gross profit for 17, we will as follows. So let me draw a line here from the formulas. And so you'll have your ending inventory, which in this case was $40,000. Your gross profit rate, which is calculated by the $33,000 divided by $110,000, which is 30%, which gives you an intra-entity gross profit of $12,000 at 12/31/17. And this $33,000 was calculated by taking the $77,000, subtracting it from $110,000. So for 18, it's very similar. You're going to take your ending inventory of $50,000, and your gross profit rate, which was $48,000 divided by $120,000, comes out to 40%. It's going to give you an intra-entity gross profit of $20,000. And again, this $48,000 was calculated by taking the $72,000 given to you minus the $120,000. So now once you determine the intra-entity gross profit for both years, the next step is to calculate net income attributed to non-controllable interest. And so you take your reported income reported net income for 2018, which was 90,000 in the problem. Then we have our intra-entity gross profit, which is going to be deferred in 2017, and that amount was 12,000. That's the calculation above. Then we have a deferral of 2018's intra-entity gross profit of 20,000 or above. That's going to give us 82,000, which is our adjusted net income of subsidiary. So the adjusted net income of the subsidiary is 82,000. Fix that a little bit. Now the outside ownership was 10%, remember, because they own 90%. So that gives us a non-controlling interest of 8,200. So the answer is 2.